Veterans, did you know you could lower your mortgage payment with minimal paperwork? If you have a VA-backed mortgage, you could be missing out on an easy way to lower your interest rate and monthly payment with a few other exclusive features that may shock you. It's called the VA IRRRL, IRRRL, and today we're breaking down how it works and why it could save you time, money, and stress. If you're not a subscriber, now is the time to subscribe, like, and share with a fellow veteran. All right, Lindsay, so we're talking about IRRRLs.
IRRRLs, not the person.
Not the person.
No, the VA refinance.
Correct.
Awesome. So what exactly is a VA IRRRL?
Great question. So a VA IRRRL is a Veterans Administration loan called the Interest Rate Reduction Refinance Loan, IRRRL. IRRRL. And so basically what it does, it's a loan that has lots of features and benefits, but the main thing is it allows the veteran to refinance their loan very easily, and we'll talk about that, into a new loan to reduce their payments and so they can have a lower monthly payment. Reduce their interest rate so they can have a lower monthly payment.
So kind of like a refinance, but specific to veterans. So what
Correct.
are some of those benefits that you mentioned?
Well, there's lower documentation needed. They don't really have to credit qualify again because they've proven they've made their payments on time for like a year, and that's one of the requirements. So the Veterans Administration says, look, you've been making your payments on time, so it stands to reason if we lower your interest rate, lower your monthly payment, you'll continue to make those payments on time.
You've proven yourself.
Yeah, so the first one is a lower monthly payment, reduced documentation. We don't need as much from you. You're making your payment. You've proven you can make the payment, so we don't need as much from you. It can be a second home or an investment property now. You just had to have lived in the property at some point. So a lot of times we have veterans that, they buy a house one place because they're stationed there. They PCS to a different location. They don't sell their house. They just rent it out to maybe another active duty service person or veteran. And so then they have this investment property there. Well, the VA says you can still benefit from an IRRRL by reducing that payment on that loan as well. So
that's pretty cool.
Don't just knock it out because if it's an investment or second home. Now, to buy a house with a VA, you need to be a primary residence.
Right.
Lower closing costs. A lot of lenders like Morgan Financial, we reduce our closing costs on these loans. They're not as hard for us to do. So why do we charge the borrower all kinds of things if we don't have to do those things? So typically lower closing costs. Lower interest rates, right? It's not hard. The company like us and other lenders, they typically don't need to make as much because it didn't take as much of their time, so they charge less. No monthly mortgage insurance. It's a VA loan that doesn't have private mortgage insurance, PMI, or monthly mortgage insurance, it's known as. And finally, for the most part, you don't need an appraisal.
Wow.
And that's a huge benefit.
That's a big benefit.
Because it's not guaranteed, nor can I say that, nor do I want to say that. But it makes it a lot more likely that it's going to happen, that you're not going to have appraisal problems as long as it's within the realm of possibility.
Sure. So what are some of the requirements for a VA IRRRL? This isn't just for anyone, is it?
Correct, yeah.
Okay.
And I kind of got into that, but I'll go into a little more depth. The first one is that, again, you have to have a VA loan. You can't do this if you have an FHA, a USDA, a Fannie Mae, one of the A's, right?
Can't squeak by with my conventional loan.
No, I'm sorry.
And also, I didn't serve, so.
Yes, correct. You have to earn the benefit.
Gotcha.
The payments for the last year must have been on time as promised.
Okay.
So if you were 30 days late just one time, you probably aren't eligible for an IRRRL. You might be under certain circumstance, but probably not. You might have to wait till a year has passed. 210 days since you got the loan, right? So typically it's 210 days from the note date, the date that the note was signed. Let's see, you have to have a payback, and this is the biggest one. I would say that the fees can't be, the rate has to be enough of a reduction that you have a big benefit. And the benefit comes in that difference in monthly payment, right?
Right.
But that benefit is judged, I guess you could say, by how many months it takes to pay back the cost. Because typically the costs are rolled into the loan. And so the VA says you have to have a payback period, and I'll do the math for you in a second, of a 36 months or less. So if the cost, based on a very specific formula the VA requires, if the costs exceed that, let's say the costs are $3,000 and you're benefiting $300 a month, well, that's a 10-month payback. that meets the VA guideline.
Yeah.
But if your costs are $30,000, let's just say, I know that's an extreme measure.
Yeah.
And you're still only saving $300, well, that's a 100-month payback, right? So that doesn't work.
Not worth it.
It has to be 36 months or less. And this is really good to protect the veteran from an unscrupulous lender that would try to convince you, through words that this is a good deal. And so the VA won't even do that loan. They won't allow you to do that loan.
Always looking out. That's
awesome. So those are the requirements. Now look, there's some other things, like if you're going from a fixed rate loan to an adjustable rate, that they want you to credit qualify. It's still considered an IRRRL, but they're going to want to see documentation to make sure you qualify for that.
Yeah.
Or if you're going from like a 30-year loan to a 15-year loan, your payment's going to go up.
Yeah.
They want to make sure you qualify to protect you from, putting yourself in a loan that maybe you can't afford according to the VA.
Do you have to get the house appraised again?
That's another great, thank you for reminding me. That's another great feature is that, like we did say in the features, that the appraisal isn't necessarily needed. Now, some lenders might require an appraisal or what's called an AVM, or an automated value model, to make sure that the house is worth somewhat what they're lending on it.
Yeah.
Pretty close. But all in all, no, typically appraisal is not needed.
Okay. So if you're ready to save, but you're not sure where to start, what do you do?
Okay. Well, the first thing is to talk to a reputable lender. I'd love to plug ourselves. I mean, Morgan Financial's been in business for 23 years, veteran owned, veteran operated, and veteran focused. And, we do the right thing for the veteran time and time again, because they served our country, they've earned their benefits, and we want to help them use it. Now, if you're not in the state of Florida, find a reputable lender to talk to.
Yeah.
Have them help you see, where are rates now? What are the fees to get those rates? What's my buyback or my payback period? What is my payback period on that loan? And if the lender tells you it's 28 months, okay, you want to see the paperwork?
Yeah.
But that makes sense, right? If it's less than 3 years. Now, so what they want to do is, we have contact information down below. Reach out. We'd love to talk to you. Even if you're not buying a home or refinancing a home in Florida, we can still help give you good advice, and we'd love to do so.
Awesome. So last question for you. Why wouldn't a veteran want to do this? Because it sounds pretty awesome. Why would you not want to?
Well, I mean, saving money is important, but you're not going to save the money if you sell the house within a certain period of time, right? So if the payback period is 36 months, if you're going to be PCSing to a different, base within that 3-year period, it might not make sense, right? If, the payback period isn't 36 months, it might not make sense, right? There's lots of instances where it might not make sense, but the main one being is that you're not going to be in the house. Or if you really think rates are going to go much lower. But I would caution people on that, because you can chase lower rates and they don't actually happen, and you missed out on an opportunity at hand.
Yeah.
So if you have an opportunity to save money, it makes sense for you. You might want to look considerably at taking it.
Yeah. That's awesome. That's all I got for you today.
Cool.
Great advice, though.
Well, thanks for watching. If you have any questions, comments, anything, put them down below. We'd love to hear from you. And if you're not a subscriber, and if you've made it this far, please do us a favor. Hit the subscribe button, hit the like button, and share this with someone who might benefit. That's all I got. Thanks, Lindsay.
Thanks for having me.
We'll see you next time.